Hello and welcome to Advisor Gold, the missing allocation, the show where financial professionals learn the why, how, and what to help their clients own physical gold and silver. This podcast is designed to complement the training at goldandsilveradvisors.com. I'm your host, Kerry Morris, and I work with clients and run a financial planning practice every day. We've used physical metals in our financial plans for nearly a decade. And I'm here with my co-host and friend, Ryan Long, second generation in the gold and silver business and president of National Gold Consultants, which only promotes their business through a large advisor network. If you're a consumer listening to this podcast, welcome. This is not financial, legal, or tax advice. It's education, folks, and you're welcome to have your advisor reach out to us, or you can email us directly with your questions. In this episode, we're going to answer the question, what is spot price and how does it relate to physical metal pricing? This can be a confusing question for advisors and their clients. You must be able to answer this question clearly, though. So today, you're going to get that clarity, along with some bonus context for your client presentations. Now, here's my conversation with Ryan. Well, welcome to the podcast, everybody. Hey, this is Kerry. I'm here with my co-host, Ryan. It's been a little bit, Ryan.
Sure has.
Today, we're going to answer, as you heard, we're going to answer the question again with a 2026 update. What is spot and how does that relate to physical metal pricing? This is an issue that's kind of developed in the recent events. And so we're kind of dating this episode a little bit, Ryan, but that's okay because the main purpose of this podcast is to support advisors who are adding this to their practice and really kind of an in between the training thought a little deeper on some subjects. So let's start again with just what is spot, right? That's one of the most asked questions that you guys get when people advisors are calling in. Jake, your staff's interacting. Like, there's a lot of confusion there. So let's just start with what is spot.
Yeah, no, I like it, Kerry. We can do through the K through 12 education here, right? And this is probably the K and the K1 aspect of the what is spot price. Well, the reality is spot price is the basic index of the universal term for how gold and silver is classified as a price. Okay, so what I mean by that, unpacking it is the paper version or the stock market version of what the gold and silver market, the barometer of the entire market looks like. Okay, it has nothing to do with a real metal, right? It's all about a paper promise for future delivery, Kerry. But that's what spot price is, and that's essentially what the ETF and the indexes are based off of.
Yeah, so it's in the news. You can pull it up on your phone in 2 seconds, right, everybody? So, the way I encapsulate that, Ryan, for clients is I just say, hey, if you kind of picture the globe, like any given day, there's this kind of like agreed upon price that's like a baseline, and it's driven by the markets. Like you said, the securitization of gold and silver, like GLD, SLV, all these exchange traded funds. But it's kind of like this number that everybody at least has some kind of baseline, right? So there's a lot of comparison to spot. There's a lot of confusion, people thinking they can buy something for spot. It's like, and I guess what goes into that, just to take another couple seconds, is, is there any, I'll ask you, you know better than me, is there any relation to the actual organic cost of getting it out of the ground and like from origin to production of a stamped coin, or is there any relationship to even the mining situation that follows that up or not?
In very short windows, Kerry, I'll say the word possibly, right? When we have large spikes up or maybe large spikes down, there could be some relationships, but I like to give the example of this. Consider spot price similar to a commodity index, right? Coffee or oranges or orange juice. Can you go to Dunkin' Donuts or Starbucks and say, hey, I want a cup of coffee based upon the coffee index? The answer is no. I mean,
I love it.
If the coffee index rises, you're eventually going to see Starbucks rise their prices, but they're differences, right?
Yeah. So it's less about the origin and it's more about the point of delivery of what's going on at that moment, right?
Right.
Fear, supply and demand. Let's say that there's a big freeze comes in and it freezes half the coffee supply in the world. Well, what's going to happen, right?
Right.
So today, in a minute, and I don't know if there's anything else you want to say about spot. It's just that's what it is, right? You can look at it, you can kind of reference it. it's going to jump around. I guess we should take an extra pain here to make sure we mention really, again, that connection to, you might say, the stock market, right? And so it's so obvious if you look back and you compare the historical chart of like the S&P, for example, and you compare spot to that, you guys, you'll see when there's a big sell-off in the market, spot is drugged down, Now, for us, when we are enjoying ownership of physical metals, we're adding that to our clients. For us, we like some separation from that volatility using physical, right? So I guess let's move on to now, how do we relate in our mind properly? It's very tempting for advisors to improperly relate this. You guys deal with that a lot. How do we relate that properly to what we see the price of a physical coins, for example, not collectible, but let's just stick with general circulation. If it's not, let's stick with what we do, right? That you guys learned over decades. If it's non-qualified, pre-33, sovereign minted general circulation coins, and if it's, of course, IRA, then it's going to be a Canadian Maple Leaf or an American Eagle. So take us from spot to what those cost and how crazy that is, and while we're doing a 2026 update.
Yep. Right. Well, Terry, I want to look at just the history of it, and so many advisors, and myself included, we look at windows of just short term. What's it done recently? Why is it behaving the way it is in this short scenario of what we're looking at? But I want to unpack and just say, hey, what does history tell us? What does it look like in the last 100 years versus the last 30 days or whatever that might be? Historically speaking, there is a disconnect of spot price and physical. And historically speaking, the disconnect is physical costs, substantially more than spot. I mean, again, it's that coffee index versus Starbucks, right? There's a difference of acquiring the actual beans, shipping them to Starbucks, grinding them down, have a barista make you a pot of coffee. There's costs associated with that. The same with the physical market of gold and silver. So the last 100 years, we can say, yes, there is a disconnect. You have spot price as your general barometer, and then you have physical. It doesn't matter if you're in IRA coins, if you're in the pre-33 coins, whatever that might be, there's always been a demand premium above and beyond that. Okay. Now that demand premium will shrink or rise based upon times of war, look at Ukraine, look at Iran, there's so many different things that has happened. I mean, this dates podcast, look back 2025, look back early 2026, you're going to see, swings of up and down of physical gold and silver. What we have seen carry end of 2025, first part of 2026, we saw a large spike of the spot price of gold and silver, right? Well, why? Well, our monetary, numerous reasons why we saw a spike. It's finally doing what it's supposed to do. And it always has. You look at the last 100 years. But we saw a big spike of spot. And then we saw a lot of people forgetting why they purchased metal, or maybe forgot the insurance aspect of it. A lot of people sold off and liquidated because it spiked. Well, simple supply and demand. If there's a large amount of supply and less demand at that point, those premiums dropped, right? So short-term windows matter, but we have to look at the long-term windows of the real whys and how spot price versus physical actually relates.
Yeah, man. So in the 14, 15 years that I've been working with you and adding physical metals to my practice, I've seen that happen so many times, right? I was there in the big 2011 when it shot up, and then boom, there it came back down, etc. So, all right. So I love the coffee example because Starbucks is who's interfacing with the marketplace, the retail marketplace, right? And so we know by working with National Gold Consultants, we're getting as close to a wholesale arrangement as we can, because if you're not the biggest, you're one of the biggest in the country in the areas that you deal with and that we mentioned. So the premium goes up and down. Let's go back to the sell-off, right? So price, because this is really what this podcast is about, to help you guys understand. So when prices rose, what are people tempted to do? Actually, that's fine. Sell when it's high, but is it really high? But you made a statement. You said it's doing what it's supposed to do. And I don't want to miss that for somebody's just listening to this podcast. Maybe it's a consumer who tuned in. What he meant by it's doing what it's supposed to do is it's keeping up with purchasing power. Expound on that for just a minute, bro.
Yeah, we get questions often from advisors. What's it done recently? Or is it a good time to buy? Or, maybe it will buy the proverbial dip and things like that. And those are all human nature things. And I can completely understand what the whole premise of what gold and silver does is when gold and silver rise, I like to pose the question, is gold and silver rising, or is your dollar just buying that much less of everything?
Exactly.
And that's what's happening here. I mean, we're printing dollars. We're continuing to raise our deficits, raise this. Gold and silver is just doing its thing, keeping up with what is happening with our monetary system. That's all.
Yeah. So there's economic drivers where the dollar loses value, that causes it to rise. There's also when there's fear, when there's a flight to safety, that's going to affect it in an upward direction at times as well. So coming back to that premium over spot, you guys just always have that in your mind that it's going to change over time. A year from now, it might be here. A year from there, it might be here. A year from there, it might be here. Let's take silver, for example. Let's say it goes to 300 like a lot of people think. Well, all those people that sold, they're going to have to rebuy at a higher price if they want that wealth protection. And of course, you and I aren't going to miss an opportunity to say, hey, the reason why you might say promote or are fans of having an allocation of physical metals is because it's like wealth insurance. And so if all your dollar-based assets tank and spot price goes with it, historically, physical metals are going to rise at that time, which balances the ship and keeps your ship level, keeps your wealth the same. That's why you have to just kind of like go through these times.
Yeah.
And it's probably not a good thing to sell, but these conversations come up because we have new clients coming in the marketplace. And so go back to hit your example real quick, Ryan, where what the advisors see, like say the spot price of silver double, but then their values aren't doubled because of the sell-off. Can you break that down real quick?
Yeah, so we've seen 2025, we saw a large spike of both gold, but especially silver. We always tell people silver tends to exaggerate, but also delays gold. When gold increases, silver hangs out for a little bit and then exaggerates, right? We saw the exaggeration of silver in 2025. And so we saw, just industry-wide, not just us with advisors, Carrie, and their clients, but just industry-wide, people that have hung out with silver in their safe for a while, they saw the spike and they're like, well, now it's the time. I'm going to cash in on it, which there's a time for that, sure. But what that caused just worldwide was a massive sell-off of physical. There's only so much capital in cash that can be used to liquidate metal. So what we saw, and I saw this from the world's largest refineries, is they basically said, I don't want any more silver because we can't process it in time, and there's only so much cash. We saw spot price carry, and the physical price was up here, and it went like this. Here comes down, right? We actually saw a negative premium on the physical metal in the first part of 2026, just because there was so many individuals liquidating, not enough time to process liquidations, and there's not enough money to process it. So they were trying to discourage people from liquidating. I would say, Carrie, in my last 20 years, and my father 30 years before me, this is the first time we've ever seen negative premiums. But that just shows you the organic, simple trade of supply and demand, that it's, we might have had silver go up 100%. You might have only made at this short window 60%. Can't help it. But again, you have to look at the longer term pictures instead of these short, what's it done in March type of a scenario. That's not what we're looking at.
Yeah. So it's not a good time to follow the herd. Warren Buffett's ringing in my head, right? Like, that's more of a buying opportunity if we were going to talk about that. We don't advocate trying to time the market. This is a hard asset. It's a long-term hold for that wealth protection. Okay. So don't get caught up in the short-term trend is really the message today.
And we understand that me and his advisor, Ryan, we all have to have conversations inside of this short-term trend, right? But the purpose of this podcast was hopefully to help you understand. I just had a conversation the other day with a guy, and I was helping him realize that, hey, there's been a big sell-off, and so that's why we're seeing, that effect. And that's going to change. Again, next year it's going to be different. So as long as you always stick back to the tried and true reasons why own gold and silver, right? Why do I have it? Why does Ryan have it? Why do my clients have it? Which, by the way, understand why they have it. And through the storms of COVID and things like that over the years, they stay steady because they know why they have it. And they've seen their wealth balance out. They've seen their wealth preservation happen, And so it's very important that you become an advocate of the right reasons to own it. And if you do that, then your clients will understand why they own it, and they'll go through these storms just fine. But I understand that right now, for new conversations that you're having, you need to explain this. You need to understand sometimes why it is what it is, but always project towards that long term. And this is it's a great time right now, actually, right, Ryan?
It really is. But Carrie, it goes back to the premise of why the pre-33, why we're doing this, why the privacy, why everything, right?
Right.
The 20%, the 10 to 15 to 20% of clients' assets, don't get caught up in the short-term trade. But when you have lower premiums than normal, if you want to look at 100 years normal, that typically would then indicate that it's a pretty good time to buy.
Yeah. So when everybody else is heading for the exits, that's pretty much the rule, isn't it? So anyways, I hope this helped you. What is spot? What's the relation to physical pricing? 2026 update. We'll see you in the next podcast.